Hello, everyone. Thank you for taking part of this. I really appreciate the CMBA for having me here and being part of the Mortgage Innovators Conference. A little bit on Insellerate. My name is Josh Friend. I'm the CEO and founder of Insellerate. Really, we're in the business to help lenders close more loans. We are currently helping lenders process over 100,000 borrower applications a month. We have two core products that we use. That's our CRM lead management, desktop and mobile, which we'll be doing a mobile demo later in the show. Which we hope you guys all tune into. And then also the engagement platform, which is going to be emails, direct mails, social media, text messages, ringers, voicemail, phone calls. To give a perspective of the data that we look at and why we're talking about radically changing borrower engagement, a little background. Our platform in the last 3 years has handled over 2.6 million borrower applications and 66 million prospects. So if you take a look at how many touch points each one of those have had, we're talking hundreds of millions of different touch points and data points. So we really have a good idea of what's happening on the mortgage side with consumers and what the trends are. I think to look at that also, let's just look at what's happening to the mortgage industry, right? Brand loyalty right now is at low. 19% of consumers go back to the same lender. That's not very good. You have costs to produce have drastically risen. Now I understand the last 6-9 months, lenders are saying, no, my cost per produce is really low, and it's probably been low for an all-time low over the last 3 or 4 years, but it's still much higher than it used to be. And it's not. This isn't a normal market, but cost per produce went from $3,700 to $8,400. So it's getting more expensive to find customers. It's getting more expensive to process customers. We also know competition is high. There's over 16,000 registered NMLS mortgage companies out there. They all have access to the same loans we're selling a commodity: Fannie, Freddie, FHA, VA, non-QM, and everyone has access to the same non-QM now. So competition is very high, and consumers are really wanting a better experience. Now, this isn't new to the mortgage industry. It's not new to any specific industry. It's been around for all industries. Consumers constantly want more convenience, better technology, and an easier process. Kind of highlight that. Harvard Business Review did an article recently on reinventing the consumer direct business model. And something I thought was really interesting in telling about what happens to lenders, or not lenders, but companies who don't respond to understand how to engage with their consumers now in this direct to consumer world. Top brands for 10 categories were unchanged from 1923 to 1983. For 60 years, it was Gillette. It was, whatever the shaving cream was, whatever the hairspray was, whatever the food, Oscar Mayer hot dogs. That didn't change for 60 years. Then around 1983, this direct-to-consumer business model really started kicking off. Consumer goods, different products were getting sold to consumers, and that really started to change those consumer brands and who was actually at the top. Now you can take a look at it. What does the rest of the market look like because of this? Look at, Casper. You have Amerisleep, you have Nectar, Helix, Purple mattresses, Puffy. There's all these different Lux. There's all these different mattresses out there. Companies, consumer direct. Dollar Shave Club, we've seen that company. Most people have. You don't have just Dollar Shave Club. You have the Athenian Club, Birchbox, Bevel, Harry's, Billy. All these additional direct to consumer. Kitchen. I know this is something that during COVID, at my house we used a lot of. We went on and ordered stuff from direct to consumer. Send me meals that are, some are pre-made, some are halfly made, but give me this stuff and buy them directly. Then you have shoes, clothing apparel, Allbirds. That's a very popular brand. Most people know Allbirds. Also Kizik, which is a slip-on shoe, which happens to be my favorite. They're unbelievably comfortable. There's all these other online direct-to-consumer shoe brands out there. And this is, really leveraging technology. Then obviously, we don't want to forget Amazon, right? So Amazon is really heightened this level of direct-to-consumer, allowing you, the consumer, to buy things through many, many different channels. What's interesting is, let's take a look at what happened in the mortgage industry. And in that, let me step back. In the article about the direct-to-consumer brands, what it said is these early brands really took advantage of the market. So the ones that were early in on the direct-to-consumer brands took advantage of the market. Now it's getting crowded and it's more difficult to compete. So now to get in that space, it's costly for these brands to make the shift. You can see that in the mortgage industry, we've had brands for years and lenders who made a lot of money in the consumer direct world. Yeah, Ditech.com. If you guys remember Ditech, I mean, they are still around, but the original Ditech that Paul Redham had, they're upwards of 20,000 loans a month, actually about half a mile from my office currently, all consumer direct. Paul sold that company for hundreds of millions of dollars. You had the Money Store. That was consumer direct. They were doing direct mail. They were doing television. They were doing radio ads. That company sold for, it was one public sold for over $2 billion. All consumer direct brands. Also, let's not forget, right now we know the name Loan Depot. How about Anthony Shea? Anthony Shea's been in this industry for a long time. Loans Direct, if you guys remember that company, that was sold to E-Trade. Home Loan Center was sold to LendingTree. Obviously, you found that Loan Depot. So there's been people making a lot of money, doing a lot of stuff in the mortgage industry and consumer brands. Quicken Loans 20 years ago wasn't a top lender. 10 years ago, I don't think it was a top lender. Now they're top lender in the country. How? Well, they are a example of invested in technology and rapidly growing. And it's not just these long-term household names that have made waves. New companies are able to come in here. And we have a company like, for example, for JFQ, in less than 2 years, they're now in a consumer direct world. They're going to be close to $5 billion in production. Within 12 months of business. That's amazing. That's using technology. Now, what we can see is the history lesson of what happens with companies who fail to make that shift. This is a little stock chart. It's on the left-hand side, Sears, and the right-hand side, it's Amazon. On the left-hand side, Sears' highest stock price is 150. Amazon is around $1,900. The scale is more than 10 to 1. So the right-hand chart would be 10 times as high as left-hand chart, but it's an indication of what happened to companies around the same time period. First, understand, what did Sears do? Sears sold you products. They took pictures of items. They were allowed you to buy a product when you're sitting at home, when you're in the car, anywhere you wanted to. You could look at their product and you could buy it. They originated this online world, this consumer direct model, being able to go right out to a customer. That they were the ones that founded this and really made this work in America. If you take a look at this here, the right-hand side is Sears catalog. It's the last catalog from 1995. And we got a Best Buy there for $279 for a VCR. That's some old technology, but that's the last catalog they had. 1995. The left-hand side is Amazon. A little bit after the left-hand first web page, the right one is the middle one's the second web page. The right-hand side is a current web page. I mean, look at the quality of difference between the two. Amazon does not look as good as Sears. Amazon doesn't have the money that Sears has. Sears has more money. They have more technology. They have better pictures, better graphics, better writers, a better brand. But yet they got beat by Amazon because they really failed to see where the market was moving, and they did not move with the market. Let's talk about engagement now with our borrowers and how we can extend this in the mortgage industry. Who I want to hear has had this experience. This is my Facebook feed and my Instagram feed. And here I was in Facebook. I'd gotten this Monday.com, which is a workflow management tool. Somehow I got targeted as someone who runs a technology company or a team to use this Monday tool. And guess what? It also showed up on Instagram. Now they might email me or do some Google AdWords. That's very powerful, right? Because now that becomes very known to me. And if I see that over and over again, when I look to buy or make that decision, that's who I'm going to move forward with. Questions, how does this happen? What do you do? Well, actually, it's very simple. It's just digital retargeting, where you can reach audiences through multiple channels and through multiple means. This specifically is using custom audiences in Facebook or Google AdWords or Instagram. You can do it in LinkedIn. You can do it in Twitter as well. And really what that is let's give you an example for Facebook. You really want to think about how we as an industry have been handling Facebook. We give loan officers the ability to post things to their own webpage or their own Facebook feed. Great. But if the average loan officer has 300 or 400 people that follow them or friends or 500, that post only reach those 500. And how many of those people are actually in the market for a loan? Those are going to be friends and family and acquaintances, not necessarily people that are trying to do business. So that has been a struggle point in social media marketing. It doesn't actually target the customer, custom audience. What our system does, it actually drops those people into custom audiences, which means Instead of 500 people, if I have 5,000 people in my database I want to connect to, I can reach out to those 5,000 people through Facebook or Instagram or Google AdWords and actually drop a campaign in front of them, whether or not they're following me or they're a friend with me or not. And now I can really massively engage more customers and really change that dynamic of now I'm showing up in multiple places. And it's not just digital, it's not just these new technology, it's also combining traditional and non-traditional. Amazon uses direct mail. I've gotten a piece of mail from Amazon before that alerted me that I had not used my Amazon Prime video subscription. I opened the email, opened a piece of mail, my mailbox, opened it up and said, "Dear Josh, you are a member, you get it for free," something to the effect of, "Here's 2 or 3 suggestions, why don't you log in?" I did. And I had seen ads for this multiple times, emails from them saying you should use Amazon Prime Video, it's already paid for. But it was that direct mail, it kind of brought it all together. So whether you're using traditional or non-traditional, you really have to be able to combine all these pieces together and really give a really rich environment. You're also, always on, right? Whether that's live chat, your customers have to be able to get a hold of you, whether it's text messaging, and making sure you have text messaging, make sure it's extended mobily so that text messages are able to be responded to in real time. How frustrating if you're a borrower, if you reach out to me and say, "Hey, what's going on with this loan," through some automated marketing campaign, and I say, "Gee, can we talk right now about it?" Or, I made an offer and you can't respond to me. You need to be always on through as well as email, phone. You need to be able to accept through direct mail. A study we've done several years now, this is just an example of it, is our MBA study where we contact lenders and we track to see how much they are always on. And it's surprising every year that we do this, how poorly as an industry that we're doing this. This study showed 58% of the time, lenders never responded to an online inquiry, not even one time. So think about that. Over, thousands of, we've done this now, I think probably over 3,000 lenders have been in the total combined surveys. And on average, over 58% of the time, they don't respond to any leads. We ask for a loan, and we get no phone call, no email, nothing. Of the people that did respond in 2017, only 0.4% used text. In 2018, 9% used text. We have not done one for 2000. We didn't do one in 2019. But text was 9% in 2018, but yet text is the most responsive form of communication. 98% of text messages are read within 2 minutes of receiving them. Ellie Mae came out and said that 97% of consumers would appreciate text messages or would be open to text messages in the loan process. But yet we don't use text messages as an industry. And part of it is because of the problems we have with not having text message being able to be mobile or being able to be two-way communicated. Again, that becomes frustrating, or it's also because of compliance, right? So you have to be able to compliantly manage what text messages. You have to be able to manage opt-in, opt-out. You have to be able to keep a record if in case there's ever an audit of what was said to this customer. So those have all been challenges, those have all been struggle points. If you tune into our demo, you're gonna actually see our platform and see how you can text message through it. It's mobile, so it works with engagement, it works desktop and mobily. So now things like text messages will allow you to be always on. Really kind of sum it up, what lenders really need to do right now is invest in technology to improve their tech stack. And then ultimately, one of the things that we need to look at is, how do you get really good at what you're doing? One is align your data so you can automate engagement. Make sure your systems in your platform, if you want to be able to do really great borrower engagement, radically change how you're doing now, you need to have really good data alignment, so that way one system can manage outreaches like emails and texts and social media and direct mail and phone calls, and actually be managed through a single platform. Outline your borrower experience, understand what it's like to get a loan from you. How do you go from start to finish, and what it looks like. Invest in technology. Technology is not an expense, and marketing is not an expense. Those are investments, they make you money. And then be virtually accessible. Right? In this marketplace, you have to be virtually accessible. Whether they call you or email you or go online or meet you face to face, you have to be able to manage that customer from the very first hand raise to repeat business, and you have to be able to do that efficiently. We really want to thank the CMBA for having us on here. And all you that are watching this, please if you want to find out more about us, go to our website. And also, we have a demo of our mobile application coming up. So please tune into that as well. Thank you.